You're welcome to Inside Business. We're going to start with chapter 1, Introduction to Business. So what is a business? A business is an organization that buys and sells goods and services. So it's a business because they try to buy, there's exchange of goods and services in between buyers and sellers. That's why we call them a business. We have two types of businesses. We have the commercial businesses and the non-commercial businesses. So why do we call them commercial businesses? We call them commercial businesses because they provide goods and services to consumers and aims to make a profit. So they are commercial businesses because they come up with a business idea, and as soon as they come up with this idea, they tend to sell these ideas to people in exchange for money and with the hope of making a profit. These are what commercial businesses are. And now we have the examples in the screen already. Then we have non-commercial businesses. We call them non-commercial businesses because they put people and the community ahead of profits. So they tend to provide the service for people and run like a business. Yeah, they are a business too, but their aim is to make society a better place. So that's the difference between a commercial business and non-commercial business. A commercial business tends to make profit. A non-commercial business puts the people and community ahead of profits. So that takes us to stakeholders. Who are stakeholders? Stakeholders are individuals and organizations that are affected by the actions, objectives, and policies of the business. So literally, we mean stakeholders are people who have group of people or organizations that have interest in the business activity. So examples of stakeholders are entrepreneur, investor, employer, employee, producer, consumer, manager, supplier, service provider, government, and the local community. So we're going to take it one at a time. So an entrepreneur is a person who spots a gap in the market and comes up with an idea that they can turn into a business. An entrepreneur takes financial and personal risk when setting up a business. They hope to earn a profit from their successful business idea. So the first stakeholder we're going to talk about here today is an entrepreneur. And when we talk about an entrepreneur, we're talking about that individual who has taken the risk to set up a business. And as soon as they set up this business, their aim is to make a profit out of it. That's why the reward for every entrepreneur is to make profits. Then we have the investors. Who are the investors? They are the ones that put money or capital into the business. Investors are the people or organizations that provide the entrepreneur with the capital, money needed to establish and operate the business. So they are investors because they finance the project, they finance the business. So what are the types of capital they could put into the business? We have the loan capital. So the entrepreneur takes out a loan from a lender such as a bank. The amount of money borrowed must be paid with interest within an agreed period of time. There's a loan capital, which means we're taking a loan to start a business. And if you are taking a loan to start up a business, it simply means you have to pay interest and also pay the amount involved, the principal, at an agreed period of time. Then we have a grant. A grant is just like a financial aid also. So money given to a business by state agencies such as the local enterprise office, the grant does not have to be repaid as long as the receiver meets certain conditions. Example given, creating a certain number of jobs. So for grants, it's just like a financial help from maybe the government. So this might not have to be paid back, in as much as the business is able to meet up with the specified requirements. Then we have the equity capital. For equity capital, which is part of investment, these are money invested in the business by individuals or businesses. These investors become part owners of the business and are entitled to a share of the firm's profit, which is known as dividends. So we have equity capital, which simply means certain individuals have, bought stake in the business. And because they've bought stake in the business, they're entitled to the share of profit, which is called dividends. These are different ways in which a business can finance, an entrepreneur can finance his or her business. Then the third stakeholders we have here is employer. When we talk about employer, we're talking about those that recruit workers. So an employer recruits staff to enable the organization to carry out its business. They are responsible for providing safe working conditions for employees and paying the agreed wage or salary for work done. For the employers, they are the ones that are in charge of recruiting workers for the operation of the business. So and they are the ones that pay workers for the work done. Then wage is money earned by an employee based on the numbers of hours worked. Then we have salary, which is a fixed payment regardless of the numbers of hours worked. Then we have the fourth one, which is employee. I'm not talking about employee, we're talking about those that work in the business. So employees are recruited by the employer to work in the business in return for wage or salary. So employees offer themselves to the business in exchange for money, which is either wages or salary. The producer takes raw materials and transforms them during the manufacturing process into finished products. Producers are those who convert raw materials into finished goods. They are part of the stakeholders. Then we have consumers. Consumers are the kingpin of every business. So consumers are people who buy goods and services for their personal use. The entrepreneur use market research to find out customers, which is what we call market research, which is we have two forms. We have business. Market research can be called research methodology, but we could call it what's it called? Market orientation. Yeah, thank you. Market orientation. And the entrepreneur. So this ensures that consumers can buy goods and services that satisfy them. So consumers are the kingpin of every business. So it is important for entrepreneurs to understand the kind of products consumers are willing to buy. If not, they will lose out. Then we have managers. Managers are responsible for the day-to-day running of the business and ensure that the firm achieves its goals. So managers are the ones that are in charge of the day-in, day-out activity of the business, and they also want to ensure that the business aims and objectives are achieved. Then we have the suppliers, which are also part of the stakeholders. Suppliers are firms that provide raw materials to the business. The supplier provides raw materials held by the business to fulfill its orders. So we have suppliers who, they are the ones that give supply. They are the ones that give out raw materials to the business before the business converts them. The producers convert them into finished goods. Then we have service provider. The service provider provides services needed by the business to operate successfully. Service providers tend to operate in the service or the tertiary sector of the economy, like banks and insurance companies. We call them service providers because they are business to business. They render services to businesses to operate so that these businesses can operate successfully. They have government. Government is an institution that governs the society. So the government is the body of people that govern the country. It imposes taxes on businesses, like corporation tax, which are taxes on profit. These taxes are used to invest in infrastructure. So these taxes, the revenue gained from these taxes are used in public finance, like schools, healthcare. Some government agencies provide financial support to entrepreneurs like Enterprise Island and local enterprise office (LEOs). So also government, from the revenue they make, they can also give grants and provide financial assistance to small businesses so that they can become bigger too. Then we have the local community. For the local community, we're talking about where we live. The local community consists of individuals, households, and organizations that are located close to the business. Many firms have developed a corporate and social responsibility strategy to ensure that they behave in a responsible manner towards the local community. So the local community are where the businesses are set up. So it is important for the businesses that set up in different locality to be socially responsible. I want to talk about socially responsible. It simply means they are able to, they operate in the right manner, and they are able to positively impact in the local community or the community they set up in. So we'll go to interest groups and I will be right back. So we continue with business. We're going into interest groups. We call them interest groups because they could also be called pressure groups. They are groups of people that come together because they have a common goal. So let's read further. An interest group or pressure group is a group of people who meet and campaign for a common goal. They have more power, skills, and capital when they work together and are more likely to be listened to by the decision maker. So they can influence decisions of decision makers because when they come together, they are strong in terms of their capacity. So intergroups use a variety of techniques when campaigning to influence decision makers. This approach can include boycotting, negative publicity campaigns, and lobbying. I'll talk about boycotting. Consumers refuse to buy goods or services from a firm to show their dissatisfaction with the business. So they might influence consumers not to buy certain goods or certain product, or not to buy from certain brand to express their dissatisfaction regarding the product, and they can use lobbying, like persuading decision makers, to support laws or rules that give an advantage to their industry or to the organization. So we have different types of interest groups. We're going to start with the business interest groups. Why do we call them business interest groups? We call them business interest groups because, for example, they said these interest groups represent the interests of business owners. They are business interest groups because their interest is that of the business owner. So here we have the IBEC, which is Irish Business and Employers Confederation. IBEC aims to influence decision makers such as the government, society, and the European Union on issues that affect its members. Example given: taxation and transport. It also provides advice and support to its members in areas such as industrial relations. So for IBEC, it's just an organization that put that, whose aim is to support its members, the business owners, by influencing government decisions, by influencing different organizational bodies in favor, so that they can, so that the business owners can, they can have, they can decisions that they made is favorable to business owners. Then we have the ISME. So ISME represents the views of small and medium-sized businesses or business owners in Ireland. It lobbies on issues that affect its members. So the impact on business, if the government raises the minimum wage, it also provides advices to its members. So for the ISME, they are interest groups that represent small and medium-sized businesses. So their aim is to, influence government decisions in favor of their members. Then we have the second one, which is the trade association. For trade association, we're talking about interest groups that represent the interests of business which are involved in the same industry. So we're talking about the banking industry, we're talking about the educational industry. So these groups, they are formed to represent different industries. So we have the SIMI, which is the Society of Irish Motor Industry. That is the motor industry. So these interest group represent the views of the motor industry, dealership, retailers, and vehicle testers. It campaigns to the government, media, and the public on issues affecting the motor industry. So we have the trade association, which simply is an organization that gives support, that influence government decisions regarding the motor industry, so that it becomes favorable to the motor industry. Then we have the other interests groups, which are like the trade union. And for trade union, we're talking about groups that come together with the aim of, based on the fact that they have interest in their members. They want to support their members. They want to negotiate better working conditions for their members. They are trade union. So trade union example given: SIP2, Services, Industrial, Professional, and Technical Union, represents the views of and interests of employees in particular industries. They aim to protect and improve their members' pay and working conditions, like I said earlier. We have the trade union, which are groups formed to protect the interests of workers. Then we have the IFA. The IFA represents that Irish Farmers Association. It represents the interests of Irish farmers in Ireland and Europe. It lobbies and campaigns to improve farm incomes and conditions for farming families. So IFA is also another interest group whose aim is to influence government decision to be favorable to farmers in Ireland and other European countries. So what are the relationships between stakeholders? We have corporate relationship, we have competitive relationship, we have dependent relationship, and dynamic relationship. So we're going to start with cooperative relationship. The stakeholders work together towards a common goal. This helps to ensure better results than if the stakeholders worked independently or against each other. So this creates a win-win scenario for both parties. If stakeholders have a cooperative relationship, it simply means they are working together with the same aim and objective. And if that occurs, it means it's a win-win situation for them, because at the end of it all, they will all put together resources to achieve the company's objective, which becomes favorable to everyone of them. That is cooperative relationship. Then we have competitive relationship. For competitive relationship, it's a win-lose scenario. So let's look at it. Stakeholders work towards different goals. Each stakeholder wants to achieve a particular objective at the expense of the other. A competitive relationship creates a win-lose scenario between the parties. So if it is competitive relationship, it simply means they have different objectives, and each objective will not be achieved without any opportunity cost. So that means one objective can be achieved at the detriment of another. That is what competitive relationship is about. And it brings about a win-lose scenario. Then we have dependent relationship. For dependent relationship, it simply means each stakeholder needs one another. So for dependent relationship, the stakeholders need each other for success. One stakeholder is not able to achieve their goals without the help of another stakeholder. So we have the dependent relationship because each stakeholder cannot do without another. So they need each other to achieve their objectives. Then we have the dynamic relationship. For dynamic relationship, we're talking about changes that are constantly happening between different stakeholders. So yeah, the relationship between the stakeholders is constantly changing. At times, relationship can be cooperative or dependent, and at other times it is competitive. So for dynamic relationship, it depends on the scenario, it depends on the time. Sometimes it could be dependent, sometimes it could be dynamic, sometimes it could be cooperative. So it's intertwined. So whatever the situation is, will determine the kind of relationship they have. And if this always occurs, it simply means there's a dynamic relationship between stakeholders. So we go to understanding the relationships between stakeholders. So we're going to start with a cooperative and competitive relationship. There are many different cooperatives and competitive relationships between business stakeholders. We have the entrepreneur and investors. What brings about cooperative relationship between entrepreneurs and investors? The entrepreneur comes up with a good idea for business and prepares a detailed business plan with future profit projection. The investors decide to invest their money in the business. The investor now owns shares in the business and hopes that the firm will make a profit on which they will earn dividends. So there's a cooperative relationship between entrepreneur and investors. Entrepreneurs will come up with a business idea. They come up with a business plan also, which they have to, present to investors. And as soon as investors are convinced that there's going to be a reward or a return on their investment, they go ahead to finance the business in exchange for certain stake of the business. Then there's competitive relationship. There's competitive relationship between entrepreneurs and investors here when the chief executive officer of the business wants it in a way that they believe brings most benefit to the business. Where shareholders may be unhappy with the CEO's approach and want to remove them from the position of CEO. So there's competitive relationship if the objective of the business or the objective of the executive officers are different from the stakeholders' objective. So this might bring about conflict of interest, and as a result of that, there might be competitive relationship, and it's going to be a win-lose situation. Then we have the relationship between the consumer and the producer. What is the cooperative relationship between producers and consumers? There's cooperative relationship between producers and consumers in this aspect. The producer conducts market research, which is product market orientation, to find out what consumers like and dislikes about products. This cooperation results in consumers getting products that satisfy their needs and helps to increase sales and profit for the producers. So there's a cooperative relationship between consumers and producers in this aspect. Producers will carry on a market research, which is the same as market orientation. As soon as they carry out this market research, they're going to be able to figure out the likes and the dislikes of their products. And as soon as they understand that, they'll be able to produce goods and services that consumers would like in exchange for profits and sales, because consumers will be satisfied. That is a cooperative relationship. Then we have the competitive relationship between producers and consumers. The producer makes a poor quality product or gives the consumer a poor quality after sales service in order to save the business money. The consumer is unhappy and decides to make future purchase from a competitor. This leads to a loss of sales, profits, and reputation for the producer. Whenever there's competitive relationship, it is a win-lose scenario. Here, there's competitive relationship if the producer produces a poor quality product or a poor quality service after sales service, all because the producer wants to keep all the revenue to itself. This will make consumers unhappy, and as a result of that, they start thinking about buying from the competitors. And buying from the competitors, not alone buying from the competitors, they might also, that might also destroy the reputation of the producer. So for every competitive relationship, it's going to bring about a win-lose scenario. While for every cooperative relationship, it brings about a win-win scenario. So that takes us to employer and employee. There's always going to be employer-employee relationship. So for cooperative relationship between employer and employee, the employer provides financial rewards such as fair basic pay and non-financial rewards such as private health insurance cover. In return, employee work hard for the business in order to help to increase sales and profits. So there is employer-employee relationship, which is cooperative, where the employer provide financial services, provide financial rewards in forms of fair basic pay and non-financial rewards like health insurance for employees, and in return, the employees are able to work hard and be more productive. It's a win-win scenario, and there's a competitive relationship between employer and employee. If employer may reduce the number of employees in the workplace in order to lower the business cost, remaining employees fear that they might lose their jobs in the future and may become demotivated and less productive. So this is a win-lose scenario. So there's a competitive relationship between employer and employee. If employer sees employees as cost, as a result of that, they reduce the numbers of employees. Reducing the numbers of employees could, reduce the morale of employees, and as a result of that, they could become less productive, and that is a win-lose scenario. I'll be right back, please. So we continue with the relationship between, so we're done with the employers and employees. So we're going to producer and producer. There's cooperative relationship between producer and producer, which is business to business here. A cooperative relationship exists when two producers in the same line of business combine their resources, capital, and marketing to increase the awareness of their goods or services. This helps to increase sales and profit for both producers. That's a win-win situation, which means they both put together resources that helps the awareness of their product, and as a result of that, the return increases in terms of sales and profit increases. Then there's a competitive relationship between producers. If two producers in the same line of business may compete with each other on some or all of the following areas like price, sales, distribution, and market share. So there's a competitive relationship between producers if they have to compete in terms of the price of the product, the sales of the product, the distribution channel, the market share, because this means the sale of one reduces the sales of another. That is a competitive relationship. The business and government. There's cooperative relationship between business and government. In this aspect, the government uses state agencies such as Enterprise Ireland to provide advice and financial support to businesses. In return, the business provides employment for people in the local community and pays taxes to the government. Example given corporation tax. So there's a cooperative relationship between governments and businesses. If government uses its agencies to provide financial support and advices to businesses, and in return, businesses are able to expand and employ more workers within the local community. That is a win-win scenario. Then we have competitive relationship between businesses and governments. A competitive relationship occurs or exists when the business deliberately underpays taxes owed to the government. This results in less government revenue to fund services for citizens in Ireland, for example, healthcare. So there's a competitive relationship here when businesses, deliberately avoid or evade tax. If they evade tax or avoid tax, it simply reduces the revenue the government will make from taxation, and this reduces the financial, the public finance of government to the people of Ireland. That's a win-lose situation. Then business and the local community. There's cooperative relationship between business and local community if they work together to improve the economic and social environment in the local areas. Businesses sponsor local youth groups and community events, thus providing activities for young people in the area that help to reduce anti-social behavior. So there's a cooperative relationship between business and the local community. If the business are able to, involve in events that would boost the local community and that will reduce social vices within the community. That is competitive. That is cooperative relationship. And there's competitive relationship if a business damages the health of people in the local community through air pollution and illegal dumping of waste. So the local community might organize protests or petition against the business, which can damage the firm's reputation. So there's a competitive relationship between the business and the local community if the activities of the local community brings about negative externalities because that would damage the reputation of the business. Then business to business. There's a cooperative relationship between businesses. If two or more businesses work together to develop a product that is too expensive or complex for one business to develop it on its own, by combining their resources, the business creates a better product that benefits them all. So there's a cooperative relationship between businesses. If they come together to produce a product that is less expensive when produced, when it's being produced together than when it is solely produced. If it is solely produced, it is more expensive than when it's being produced together. So if businesses come together to produce such products, it means that is a cooperative relationship. But there's a competitive relationship if businesses have to compete with price for goods and services. If there's price war, that is competitive relationship. So then we have the producer and the interest group. For the producer and the interest group, there's a cooperative relationship between producer and interest group. If the producer and interest group work together to increase awareness of the producer's products, to influence key decision makers by lobbying or boycotting and using high-profile media campaigns. So there's a cooperative relationship between producers and interest group. If producers are able to influence, if they are able to work together to ensure that products are produced and people within the group, members of the interest group, are happy and satisfied. And there's a competitive relationship. If producers make products using raw materials that could be viewed as unethical, interest groups may want to produce. We want the producers to stop selling these items, but the producers want to continue with production as they are profitable. So there's a conflict. There's a competitive relationship between producers and interest groups. If the actions of producers are bringing about, negative externality or an ethical source to the community and to the society, and interest groups would not want it to happen. As a result of that, interest groups might protest or lodge a campaign against the businesses. And if this happens, then it's a win-lose situation. So that ends business, that ends knowing inside of a business, that ends knowing a business, that ends business for now. So this is introduction of business, and in the next class, we're going to talk about chapter 2, which is, let's see, what is the chapter 2? Resolving conflict in the marketplace. Thank you.